How much cash should you keep, owe, or invest? At 2:17 a.m., your phone lights up. Market crash, red numbers, breaking news banners, financial commentators suddenly wide awake. Somewhere in New York, London, Toronto, or Sydney, someone just lost years of gains while sleeping, and somewhere else, another person sleeps peacefully. No panic, no volatility, no drama. Their money is sitting quietly in cash, safe, stable, untouched. But here's the part nobody feels. That safe cash is shrinking. Right now, silently, no crash required. No headlines, just slow, invisible decay. And this is where the real question begins. How much cash should you actually keep versus invest? Because too little cash can destroy you overnight. Too much cash can quietly destroy you over decades. And almost everyone gets this balance wrong. Not because they lack intelligence, but because the trade-off is deeply uncomfortable. Cash protects you from chaos. Investments protect you from time. Cash prevents short-term disasters. Investments prevent long-term disasters. Both feel essential. Both feel risky. And choosing between them feels less like math and more like psychology. Let's start with the belief most people carry. Cash equals safety. Investing equals growth. End of story. Except reality doesn't behave that neatly. Cash protects you from volatility, but exposes you to inflation. Investments expose you to volatility, but protect you from inflation. You're not choosing between risk and safety. You're choosing between two different kinds of risk. Visible pain versus invisible erosion. Think about cash for a moment. Not as money, but as stability. A number that doesn't move. A balance that doesn't fluctuate. A financial heartbeat that stays calm. There's comfort in that stillness. Especially in a world that feels increasingly unstable, markets swing wildly. Interest rates jump, housing costs surge, recessions appear without invitation. Cash feels like solid ground, but stability can be deceptive. Imagine placing your money in a perfectly secure vault. No theft, no crashes, no losses. 10 years later, you open the vault, and your money buys far less than it once did. Nothing happened, yet something vanished. Inflation, the quiet tax, the invisible leak. In the US, UK, Canada, and Australia, inflation has been one of the most dominant economic forces of recent years. Prices rising, purchasing power falling, the cost of doing nothing suddenly very real. And inflation doesn't need to be extreme to be destructive. Even a modest 2 to 3% annually compounds with brutal consistency. At 3% inflation, your purchasing power halves in about 24 years. Halves, without a single financial crisis, without a single bad decision. Just time doing what time always does. This is why investing exists at all. Not for excitement, not for speculation, but for preservation. Because money that doesn't grow eventually becomes insufficient. Now let's flip to the opposite extreme. Everything invested, no idle cash. Every dollar deployed into markets. On spreadsheets, this looks efficient, optimized, rational, until reality interrupts. Life does not follow market cycles. Emergencies don't wait for bull markets. Job losses don't consult economic forecasts. Medical bills don't care about portfolio performance. And markets, inconveniently, tend to crash at the worst possible moments. Picture this. Your entire wealth is invested. Markets drop 35%. Headlines scream recession. Suddenly you need cash. Not optional, not theoretical, immediate. You are forced to sell. At depressed prices, losses become permanent. Not because markets fell, but because liquidity vanished. This is one of the most underestimated risks in personal finance. Forced timing, sequence risk. The danger of needing money when markets are least willing to give it. Investments are powerful, but only if you can afford patience. And patience requires cash. Which brings us to the tension nobody enjoys confronting. Cash feels safe but loses slowly. Investments feel risky but grow unevenly. Cash protects you from volatility. Investments protect you from stagnation. Remove cash entirely, and volatility can break you. Remove investing entirely, and inflation will break you. The problem is not choosing the better option, it's surviving both realities simultaneously. Now consider the emotional layer, because this decision is rarely mathematical. Cash reduces anxiety. Investments introduce uncertainty. Even when investors understand volatility intellectually, losses feel personal. A 20% market drop doesn't feel like a statistical event. It feels like danger. Human brains are wired for immediate threats, not long-term probabilities. Cash, by contrast, feels calm, predictable, reassuring, which explains why many people hold excessive cash, not because it's optimal, but because it's emotionally comfortable, yet comfort has a cost. Every dollar sitting idle is a dollar not compounding. And compounding is where financial trajectories quietly diverge. Two individuals, similar incomes, similar discipline, different liquidity habits. 30 years later, dramatically different outcomes, not due to brilliance, not due to timing, but due to exposure. Markets reward participation. Inflation punishes inactivity. Still, there's another irony. Cash is not just defensive, it's strategic. Cash is optionality, flexibility, the ability to act when others are frozen. During market crashes, liquidity becomes power, assets go on sale, opportunities emerge. Those with cash buy, those without cash watch. During recessions, liquidity becomes survival, no panic selling, no desperate decisions, no financial suffocation. Cash is not dead money, it is dormant leverage, but excess cash becomes drag, a slow gravitational pull against growth, especially across decades. And here's where the conversation usually becomes uncomfortable, because there is no universally correct answer, no magic percentage, no perfect formula, only trade-offs. Too little cash increases fragility, too much cash increases erosion. The optimal point is less about maximizing returns, and more about sustaining behavior. Because the best strategy is the one you don't abandon during chaos. Markets will fall violently, repeatedly, historically. Declines of 30 to 50% are not rare accidents, they are recurring features. Investors without sufficient cash buffers often make catastrophic mistakes during these periods. Selling low, halting contributions, retreating into cash after losses, ironically locking in the very damage they sought to avoid. Cash, paradoxically, can improve long-term investment outcomes, not by generating returns, but by preventing panic, by buying patience, by stabilizing decision-making. Now zoom out further. This tension mirrors entire economies. Companies hold cash reserves not because they dislike growth, but because liquidity equals survival. Governments maintain reserves not because they distrust investment, but because uncertainty demands buffers. Even central banks constantly balance liquidity versus inflation. Too much cash fuels price instability. Too little cash fuels financial crises at every scale. The same dilemma persists: stability versus growth, flexibility versus efficiency, short-term resilience versus long-term expansion. And the equation shifts with conditions. Interest rates matter. When rates are near zero, idle cash is brutally expensive. When rates rise, cash becomes less punitive. Inflation regimes matter. High inflation punishes inactivity. Low inflation softens the decay. Market environments matter. Expensive markets increase perceived risk. Cheap markets increase opportunity. Personal realities matter. Income stability, career risk, debt levels, dependence, psychological tolerance for volatility, which leads to a deeper truth most advice avoids stating directly. This decision is not about finding the perfect allocation, it's about aligning with your uncertainty. How volatile is your life? How predictable is your income? How fragile is your financial structure? How well do you sleep during market swings? Because cash is fundamentally a shock absorber, and investments are fundamentally a growth engine. Different tools, different jobs, and treating them as substitutes rather than complements is where many financial plans quietly fail. There's also a subtle but powerful psychological conflict at play: expected returns versus regret minimization. Investing maximizes long-term probabilities. Cash minimizes short-term regret. These objectives are not the same. Humans are deeply loss-averse. The pain of watching markets fall often outweighs the slow pain of inflation, which is why excessive cash feels rational, even when the math disagrees. And perhaps the most overlooked reality of all, the right answer changes. Early career, higher growth tolerance, lower obligations. Mid-career, higher buffers, higher responsibilities. Later life, liquidity becomes survival critical. Economic environments change. Personal environments change. Risk tolerance evolves, which means this is not a one-time decision. It's a recurring calibration, a moving balance between two uncomfortable truths. Volatility is unavoidable. Inflation is unavoidable. You cannot eliminate risk, only choose its form. So the real question is no longer, how much cash should you keep, but rather, what kind of risk are you more exposed to right now? The risk of needing money unexpectedly, or the risk of money losing value predictably because one arrives suddenly, the other arrives slowly. One feels like a crisis, the other feels like nothing at all, until years pass. And perhaps the most unsettling thought of all, when you look at your bank balance, Do you see safety, or do you see time quietly working against you? And when you look at your investments, do you see risk? Or do you see the only mechanism designed to outrun inflation? Because in the end, this decision isn't really about cash versus investing. It's about how you choose to negotiate with uncertainty, protecting yourself from shocks, while protecting yourself from stagnation. And the balance between those two forces is where nearly every long-term financial outcome is decided. So here's the question that lingers, not just for your portfolio, but for your future lifestyle. Are you more afraid of watching your money fall, or watching it stand perfectly still while the world becomes more expensive around you?